This is The Gist, the essential podcast for the discerning listener.
Welcome to The Gist. I'm John.
And I'm Mary. It's Thursday, July 9th, 2026.
We are your smart friends on the go. We skip the noise and look at who benefits from the day's news and why. Let's get right into it.
Today's Gist View takes us into the high-stakes casino of artificial intelligence. MiniMax, a major artificial intelligence developer in China, is looking to raise $1.9 billion.
But it is how they are raising the money that matters. According to Bloomberg, they aren't just selling standard company shares. They are using a hybrid setup with a convertible bond.
Let's define that. A convertible bond is a corporate debt instrument. You borrow money, but the lender can later swap that debt for a set number of shares in the company stock.
Traditional tech startups
Usually just sell pure equity. They give away slices of the pie to venture capitalists. But generative artificial intelligence requires massive, continuous computing power. The costs are astronomical. If these founders only sold equity to cover those server costs, they'd own nearly 0% of their companies by the time they succeeded. So they are turning to debt.
Who benefits here? In the short term, the founders keep their ownership. Credit markets offer a lower fixed cost of capital right now. It acts as a prudent financial maneuver.
But it is a massive gamble. Debt comes with strict rules. It puts a ticking clock on the balance sheet.
Exactly. They are betting entirely that their software revenue will explode before the debt matures. If the revenue doesn't scale fast enough, the company faces financial distress.
It's like taking out a massive second mortgage to fund a tech project in your garage. You keep the equity, but you better have a hit product before the bank comes calling. Moving to the global overview, let's stay on the topic of corporate debt. In Canada, Well Health Technologies is selling 150 million Canadian dollars in high-yield corporate bonds. Bloomberg reports these bonds mature in 5 years. This is a classic defensive play.
Right. The incentive here is safety. They are locking in operational funding right now before borrowing conditions get tougher. They get the cash today to protect their medium-term operations.
From finance to orbit, NASA's Jet Propulsion Lab is testing a new spacecraft sensor in the Canadian wilderness. It is headed for an orbital launch in 2027.
The goal is to measure how fast Arctic sea ice is disappearing. It sounds like pure climate science, but look closer at the resource flows.
High-resolution climate data is incredibly valuable. It is not just about tracking global warming. It is about calculating future global shipping routes.
And resource extraction. When the ice melts, new sea lanes open up, new minerals become accessible. The nations and corporations with the best data get the ultimate leverage.
Let's turn to the European perspective. In Brussels, a major fight is brewing over the European Union's emissions trading system, or ETS.
The ETS is a cap-and-trade carbon market. It forces companies to buy permits to emit greenhouse gases. According to Politico, capitals across Europe are lobbying to relax these rules. They want to protect their local manufacturing from high costs.
But Sweden is pushing back hard. Swedish Minister Jessica Rosencrantz says the rules must stay strict ahead of a mid-July review. Why the rigid stance?
Look at the power grid. Sweden already has a highly decarbonised energy system. Their factories run on clean power.
So, if carbon prices stay high, Sweden's fossil fuel-reliant neighbours take a massive financial hit.
Exactly. Sweden uses the carbon market as a competitive weapon. It looks like climate virtue, but it is really a zero-sum industrial struggle. Keeping the rules strict secures a market advantage for Swedish industry.
Next up, retail power plays. Frasers Group just launched an unsolicited €2.7 billion bid to buy the German fashion brand Hugo Boss.
Reuters reports the offer is €38 a share. That is just a 4.3% premium over the current stock price.
Which happens to be the exact statutory minimum required in Germany to exceed a 30% ownership stake. Hugo Boss management immediately rejected the bid.
The strategy is clear. Frasers wants to consolidate control without spending serious capital up front. They are testing the fences on the cheap.
Finally, a look at United Kingdom's science funding. The Financial Times reports a 15% cut to the Diamond Light Source over the next 4 years.
That is the United Kingdom's National Particle Accelerator. The Science and Technology Facilities Council, the government agency funding scientific research, mandated a £162 million savings plan.
Why? To offset operational overspending?
This is a classic bureaucratic manoeuvre. They are cutting the budget for actual scientific hardware to cover administrative deficits. The fiscal risk is transferred straight away from the back office directly to foundational research outputs.
And that brings us to the end of today's show. What's the temperature today, John?
Today's temperature is deeply pragmatic. From Chinese artificial intelligence startups mortgaging their futures to avoid dilution, to Sweden weaponizing clean energy for industrial dominance, everyone is playing a rigid defense. We are seeing major players sacrifice long-term flexibility just to secure the immediate high ground.
Spot on. If you found today's breakdown useful, we'd love for you to join our daily readership. You can subscribe to the Gist newsletter for free. It has all the insights we talked about today and more.
Just tap the link right there in your show notes to get it in your inbox every morning. Thanks for listening, listeners, and we'll catch you tomorrow.
The Gist, News Digest, and podcast are entirely written and produced by artificial intelligence. The Gist is out 3 times a day, every day, providing you with a liberal perspective on what to expect next. For more information and donations, visit thegist.online. Thank you for listening.